Okay folks, welcome back to another update for natural gas. Now the charts are showing consolidation and possible weakening, so we'll cover those in a minute. We'll include back testing, which demonstrates how you could have traded using one of two strategies. So don't forget to hit that like and subscribe button to support the channel. In terms of the outlook, as of today, June 5th, AI demand impact. Growing deployment of AI infrastructure is putting upward pressure on electricity and thus natural gas demand globally, supporting natural gas prices and creating a favourable backdrop for leveraged plays like BOIL and unleveraged funds like UNG. For geopolitical events, heightened geopolitical tensions, especially Russia-Ukraine attacks on gas infrastructure, have squeezed supply and fueled natural gas price spikes toward multi-year highs, contracting premium nearing $4 million British thermal units, lifting natural gas ETFs significantly in 2025. Natural gas remains supported by strong heating and power demand, including growth from AI data centres, while supply remains strained due to geopolitical disruptions and infrastructure risks. This environment benefits natural gas exposure. Leveraged funds like BOIL, KOLD reflect heightened volatility, and unleveraged UNG outpaces broader markets with around 30% gains year to date. As always, we look at the long-term trends first, and here on the monthly, you can see here the price is above the moving average, and so is the CCI, giving us a bullish momentum. One thing I want you to notice as well, I've introduced this fair value gap on the charts, on the bars, and you can see there we had these fair value gaps currently filled with that price movement, especially with that wick. So that's filled that area there as well, potentially. This one also was filled with that the candle activity there, so always pay attention to that. You'll find the price retraces to the downside or the upside to fill in those fair value gaps. And if you're new to the channel, or if you're new to the concept, a fair value gap, let me just zoom in here just to demonstrate. This one back here, for example. What you do is, let's look at this candle here, for example. We take the top high of that candle, which breaks after, so you've got to wait for the candle after it to complete, and you take the low of that candle there. So what you do basically, you take that low from that candle to the high of the candle after it, and that there is identified by this pink area as a fair value gap. What that means is there's orders unfilled in that range somewhere, and this one with that wick filled about 25% of them, or about a third of them roughly, but then they filled more comprehensively, more than 50% of them with that candle activity there. So the price usually retraces back to that area. Now notice here as well, just looking at this snapshot, that there is also a fair value gap highlighted on the chart. So if I scroll across, let's see if it filled it. So we go to where we are today. You can see there that wick of that candle has filled about 50% of that range there, which filled most of those orders. So that would have been effectively completed as well. So always pay attention to these, and you can see back here, even that area there, all these little areas identified with light blue or light red areas have been filled. Even that one there has been filled with the wick of that candle. So where we are today, there's a fair value gap down here, which means we may see in fact, yeah, that there, the red one was filled with that candle, and this blue one here hasn't yet been filled. So we might see a break to that. Let's go to that one. I'll stretch it out to where we are today. So we might see the price retrace down to that area possibly. It doesn't mean it's going to happen next month or next week. It could take years to play out. So this is a very long-term chart I'm looking at the moment. That's the monthly, but I'll keep that drawn there for the moment. Also, the other thing we'll look at is any divergence, and there's no divergence on the monthly. Look at the weekly. Again, you can see there more recently we had this fair value gap that was filled with that wick of that candle. Another fair value gap there also filled. That one there was filled with those two candles. And if we zoom out on the weekly, we look back, that was filled. They were filled. We have one down here which is not yet filled. So if I was to draw I'll stretch it out to that range. That hasn't been filled yet. So possibly, this could take months or even years to play out. That hasn't been filled yet with any price activity. But going back to the trend on the weekly, that's currently consolidating. It's in that middle or moving average range. even though the CCI is broken above. So somewhat bullish on the CCI, but somewhat neutral on the price. On the daily, look more closely here. We've got a fair value gap very close to where we are now, and the CCI is broken above the moving average, but it's a very narrow range you can see there, and we might see it actually break to the downside. We've got in the last 3 days we've had some bearish candles, but again we've got this fair value gap, so that may well likely all it needs to do really is to break into that and then bounce out of it possibly. But if I zoom out, you can see here we've also got another fair value gap down here. That was somewhat filled with that 20% of that one. I'm just going to complete that as well just to make it a bit obvious. So those ones in there were filled with this candle activity. But again, looking at any divergence, that CCI is moving in line with that price. So there's no divergence that I can see currently on the daily. Now if we go to the intraday chart, again, keeping in mind we predominantly take, according to the trend, we take long trades only. But back here, that would have been safe to take that long trade with that daily movement, also in alignment with this bullish divergence. Now that's slightly higher low on the price, almost a double bottom. Strictly it's not a bullish divergence, but I'm going to count that as one, and that also played out, and we projected that in our last video, and it hit it quite easily, and it retraces as far as the 100% level if we drew the Fibonacci to that point there. Now again, notice as well we've got a bearish divergence on the hourly, lower highs on the CCI versus higher highs on the price. And again, a couple of things to notice here. First off, the divergence, take it back to that low. You can see there it's already hit that 23-38% range. We'll mark it with a blue range. The other thing we'll look at as well, so it's already hit that range as a divergence, but it looks like it's still dropping. And the other thing we'll look at as well is, you can see here we've got a few, even right back to this point, to that one there. I'm going to cover all that area to, at the very least, that's a fair value gap. So we might see it break through this divergent range, which is also a fair value gap you can see there, but it's already potentially covered that area. But these ones that have not been covered yet, so you might see it break into this range in the near term, so just watch out for that. Also, you notice the hourly is broken to the downside. Now what we also look at as well, the back testing. So again, I've started the back testing here for the stop loss approach and the average down approach when the CCI broke below the moving average band there. So the stop loss approach. Now what you would have done at the very latest, you would have closed out your positions when the CCI broke into that moving average range, and that coincided with this period back here. We had a bullish divergence, as I said, and you would have closed out your position taking note of that break above the CCI. So you would have closed out your position somewhere in that range, even though we had one position open on the average down. So the stop loss approach would have generated about $700, and the average down approach, because you averaged down a few times, generated about $6,700. BIL on the monthly, we've got it the price below the moving average band. There's no CCI for it. And what I've drawn up here is the fair value gaps that are still unfilled. These ones here, that one there is probably 25 to 30% filled, I would say. That one there is about 50% filled. This one's about, you could probably stretch that down to that level there as well. But again, a few fair value gaps up here that haven't been filled, which is long term. Again, this could take years to play out, so don't go placing long orders yet. This could take years to play out, but that their orders potentially unfilled. Here on the weekly, we've got this bullish divergence, very long-term bullish divergence versus lower lows on the price that broke up, and currently we're in a bit of a downtrend. Is below the moving averages of the price chart, although the CCI is still somewhat bullish. And again, there's some other fair value gaps that haven't been filled yet. I just marked them and highlighted them for you. And on the daily, likewise, we've got a potential double bottom here on the CCI. That wasn't drawn properly. Let me just put that there. Versus the price. Yeah, that's not a divergence actually. That's higher lows. So I'm not gonna draw that. So that's still potentially a bounce, but I'm not going to regard it as a divergence. But up here, you'll notice we've got a fair value gap, and that was after this we gapped down there. That was after this bearish divergence had dropped before our last video versus highs on the price, and that dropped down to about 50 to 61% of our range if we took the Fibonacci to that range there. If we drew on the micro levels on the 1 hour chart, you can see there it's gravitating around this descending diagonal trend line. It gapped up and that caused this other fair value gap. So I'll mark that as well between that low. Now it's actually broken into that range there, so it might possibly have completed it, but I'd like to see this break a lot lower to about the 30% level, or at the very least the 50% level. But at the moment it's still showing bullish momentum, and the daily is also somewhat neutral to bullish as well. So, but I wouldn't be going long yet. When you're seeing the CCI and the price dropping, you see the price is below the moving average. I'd like to see that above the moving average to go long. So if we we take short trades from that point there, and if you go to the short positioning, I've taken the back test here, starting at around there on the 14th of May, which is that period back there on the daily. The stop loss approach, the total amount has generated about 7 points of gain, and the average down has generated 21 points. Now, again, you possibly would have closed out the position. Here we've got a double, almost a slightly higher lows, and that's almost a double bottom on the price. And there it gapped up. As I said, there's that fair value gap. So you might see it retrace further to the downside. And if you got into the trade, you probably would have got out of the positions around that point there. So the stop loss approach again is generated about 6 to 7 points, and the average down is generated about 22 to 23 odd points of returns. For KOLD on the monthly, it's dropped below the moving average band, and the CCI showing somewhat of a bullish momentum, but I'd call that a bearish move overall if looking at the price chart alone. But notice up here we've got a fair value gap, a very wide one. It did touch it here, but probably didn't go deep enough. Plus we've got another one up there as well. Again, it's a very long-term play. Don't go placing long orders based on that alone. On the weekly, we've got another fair value gap up here in a smaller time frame. Looking at more closely, you'll notice the trend is below the moving average band on the price, but also it's broken below on the CCI as well. So bearish momentum on the weekly. Again, don't go placing long orders based on that fair value gap yet. On the daily, we've got in terms of trends, we've got a bearish momentum at the moment. Both the CCI and the price are broken below the moving averages in a very, very narrow range of moving averages. We did have a bit of a bounce here. We drew a target range there. You can see it's just probably kissed it based on that bullish divergence versus lower lows on the price. Probably just touched that divergence. Looking at the micro level, the 1 hour chart, we had a very major drop or gap down straight after our last video. And where are we now? So again, predominantly short trades to be taken as of then. So from here on, predominantly short trades with the daily also showing short movements. But had you taken long trades from when the price broke, or when the CCI broke above the moving average band there, just demonstrating here on the back test. So from that period on the 13th of May, now that would have been risky because the price is below, so ideally you should not have taken that trade. And you can see there, had you taken it from that point there, that would have been probably a false break. And since then it's actually recovered somewhat. So that there was the 19th of May. So that would have been, your first entry would have been about that point there. So it would have been about a break even, or maybe a small loss had you gone long at that point. But based on the hourly chart, you can see there the price, the CCI and the price were moving high, and that probably would have been in alignment with the CCI line on the daily. So again, to be safe, I'd like to see the CCI and the daily break above the moving average bands. But based on the hourly chart with a back test here, that would have done it quite nicely, and you would have taken your profits once that CCI broke into the moving average band at that point there, and then gone long again at that point. So you would have been a few little stops out there, but I'm going to let it run through the whole period, and the whole period would have been about a 5-point gain for the stop loss and about 10-point gain for the average down. So for UNG on the monthly, it's broken below the price moving averages, but it's bullish on the CCI. So that's giving us a somewhat neutral positioning in terms of trend. We might see it bounce further up here, but again, the CCI is still bullish. I'd like to see this break above the moving average band to give us more confidence about going long. Don't go long yet. We've also got this fair value gap I've highlighted up here, and it also coincides with this bullish divergence as well. So if we drew first of all, the divergence retrace on the monthly, that's at 23-38% range. And that also coincides with that fair value gap, as I said. So I'll keep an eye on that. That's a very long-term play. Don't go placing long orders yet. On the weekly, that's already broken above the moving average band after this bullish divergence. But then the price is actually broken below again, with the CCI also showing us a bearish trend. And again, I've got another fair value gap up here with orders not filled. So again, that could coincide with this bullish break to the upside. So again, another long-term play on the weekly. On the daily, in terms of trend, a very narrow range of CCI, likewise the price moving averages, but they're both trending lower, even though the price is below the moving average, and even though the CCI is in that moving average range. I would call that a neutral to bearish momentum at the moment, so just be cautious of that. And that also aligns with this longer term CCI 1500, which is a smoother moving average to the CCI 150. On the micro charts, we look at any micro plays, even if you're trading on the daily. So again, you can see here we had somewhat of almost a double bottom on the price, although strictly it wasn't a divergence versus higher lows on the CCI, but that was also a very strong bounce or gap up to the top side. And let's see, I don't see any other divergence in play there at the moment. And you could argue that's also a fair value gap between that previous candle and that candle there, but it may have already, that candle there, but it may have already hit that range with that candle activity or at that point there. So it may possibly break further to the downside. Just be cautious of that. There's no guarantee with any of this, of course. In terms of back testing, we would have taken short trades from the daily on around the 13th or 15th of May there. And the back test here shows on the short positions, you would, again, taking a lead from the daily with short positions, the price is below the moving average, and that would have coincided with this period here on the 1 hour time frame. And again, you would have closed out your positions once the CCI broke into that moving average range near the bottom there. You might have got out on that candle there, and that would have returned on the stop loss approach just shy of 1 point there, and the average down approach would have generated about 3 points, almost 4 points. Now the prices went sideways for a while, then it dropped off again. So had you stayed in the whole period, that would have generated 6 points for the average down and about 1 point for the stop loss approach. So if you're new to trading, we're now including a video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and help give you a better insight into our analysis and help you follow our daily videos. If you enjoy the content, subscribe at least on a free trial to my Patreon page, where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.